Back here in Nigeria, the Central Bank Monetary Policy Committee on Wednesday voted to leave the policy rate unchanged at 14%, as well as other policy parameters. Now, this is the first meeting of the MPC since November 2017, after it failed to reach a quorum in January and March. Let's get a sense of the perspective from outside our shores. I'm being joined by the head economic research at EcoBank Group London, Gaimin Nonyani. Hello, Gaimin. Good afternoon. Thank you for joining us on the show.
Good afternoon.
Again, the CBN MPC chooses to do nothing despite some of the improvements we've seen in the economic variables. Was this a wise decision by the MPC at this time?
Well, yeah, I think, while it was widely expected that they would likely to leave the policy rate unchanged, although we've seen the economy gathering steam, we've seen the non-oil sector, which constitutes a very big of the economy, even more than the oil sector, expand by its largest pace in Q4 last year by 1.5%. There's still a number of imbalances in the economy, and I think it's rightful so that the new Monetary Policy Committee puts that as a central decision.
Now,
for several reasons.
Okay, the directional trend of GDP growth shows a mega increase of 1.92%. That's in the fourth quarter, implying full year 2017 growth of just 0.83%. Now, shouldn't this low level of growth be a typical reason for a cut in rates?
Not necessarily. I think that's just one side of the story. I think, first of all, we have to think that this is a new committee that's just been set up. So time to settle in their positions. And I think that if they'd come in and ended the tightening cycle that's been in place since July 2016, it would have been a very bold move, especially given that there's still a number of imbalances in the country. I mean, on one hand, you've got real interest rates still in negative territory. So cutting interest rates, the MPR rates, would have put real interest rates further into negative territory, which is not good for investment returns in local assets. And then at the same time, you've got the economy not performing well in certain sectors. So I think it was central to the decision to make sure that they continue to promote real interest rates as a main issue.
Now, this obviously or certainly has its implications for the economy. What sort of implications do you think all of this, of course, will have on foreign investors' confidence?
Well, I think foreign investor confidence is actually picking up. We've already seen, since the introduction of the I&E window last year, daily turnover at around 200 plus million, which is very good at the I&E window. We've seen a cumulative turnover of about 15 billion in Q1 this year so far, as opposed this compared to 25 billion for the entire year last year. So in just the first quarter of this year, we've seen 15 billion. It shows that in the next 3 quarters to go, we're likely to see a further increase in the cumulative turnover of the foreign exchange market. So I think as long as the exchange rate continues to remain stable, I think that's a good sign. And we've seen foreign exchange reserves picking up to about 47 billion, sufficient to cover 11 months of import cover. So these are good signs that will continue to maintain better confidence in the economy. The downside, of course, is that the country is facing an election next year, and so there could be certain downside risk towards the latter end of this year.
Now, talking about the foreign exchange market, are you comfortable where the Naira is at this point? Has it reached its fair value?
Well, I would say for now, it is actually working for the government. I mean, we still have a multiple exchange rate system in the economy, which it's not good, but it is actually working from an economic perspective for the country. We've seen large inflows come into the market, so that is a good sign that investors are gaining. There's a recovery of confidence within your market. We've seen a stability in exchange rate, and as a result of that, we've seen inflation actually slowing down. The downside, of course, to that is that the food price inflation remains elevated. So that was another issue that the government, the CBN, took into consideration for not reducing the rates, because the food prices constitute a very large proportion of the entire CPI basket. And so reducing rates could also jeopardize the inflation environment and even jeopardize increased inflationary exchange rate pressures, which could jeopardize the exchange rate stability that we've seen for quite some time now.
All right, Gaimin, just a quick one before I let you go. When do you think this rate cut will actually happen?
I think it's a matter of time. I mean, we're already seeing some dovish policies taking place with the indirect monetary policy instruments. We've seen the government actually scaling back on its issuances, its OMO issuances. So it is a matter of time that we've seen a bit of relaxation in its tightening of liquidity. So it's just a matter of time. We expect between May and July this year for a policy cuts to actually take place, and for the entire year for about 100 to 200 basis points cuts, which will take the monetary policy rates to about 12%. So I think once we see inflation actually nearing the single digits rates, it's likely to happen, and I'm confident that it will happen this year.
Let's hope so. Thank you very much for your time, Gaimin. Gaimin Noniani is the head of economic research at Ecobank Group in London. We'll take a quick break, and when we return, Ghana considers selling bonds from China to Japan, and other stories will follow shortly. Do stay with us.